Thank you. So I'm really happy that we have an almost full house because 10 minutes ago we had like 4 brave people in the middle. And I was going, you know it is when nobody wants to come and hear you talk and they put you way off in the corner. And they trick us all by changing rooms and stuff. So I'm happy here. And I'm kind of it's weird, I'm an outerwear geek and I organized the jackets for my class back in the day. So I saw the Emba jacket back there somewhere, the Helly Hansen, it's really nice. You guys are doing a very good job. And then the NBA jacket as well. It is good to be back. It's always very good to be back. Not just to come back and say hi to old buildings and new faces, but because SVCO was one of just a very small number of contact points I had with people that convinced me and helped nudge me to move to Silicon Valley and the Bay Area afterwards and sort of put me on a trajectory that has been really rewarding. And so it had a big impact on me. So it's really nice to come back and to be able to just be on the other side of that. So, and again, I was here last time, and I'm here again, so it's nice that I'm not completely fucking it up and they're asking me to come back again. But thank you for taking the time. So we are going to talk about how investors think and how to hook them. And then the asterisk that everybody can see there is a bit of a head fake. And we'll get to that. And I love head fakes. People, you think we're talking about one thing, and maybe we're talking about something slightly different. That's what we're doing today. This is my background. I put this up for a few reasons. I don't really just put it up for shiny logos. I do want you to listen to what I have to say and have some amount of credibility, but I'd rather that come out in what we talk about. I was here, I get it. Now I've made sort of that trip to Silicon Valley in about 5 years. I was at AngelList. This is where a lot of my looking at pitches and understanding what works comes from. I think I saw about 8,000 when I was at AngelList. Some I was getting 50 to 100 a day, and I was like the front door for that platform before it became more of an autonomous platform. I did some research, which we talked about yesterday, worked with accelerators, which is how Tracy and I met actually. My girlfriend has made the trip here. And then I worked at Greylock as well. And Greylock is much more like where Greylock's writing large checks. There's a lot of discussion about what works and what doesn't. And some of the most interesting conversations there, for sure, were always what happens when the entrepreneur leaves a room after a pitch and the partners and the whole team start talking about it. That's the context. Equally important for me, though, is always to have this box here about what I'm not. There's a lot of advice, and there's a lot of teaching, and everybody wants to be able to mentor and give advice, and most of that is bullshit. And so I really want everybody here to understand what I'm not. I am actually not an investor. I did not write checks at Greylock. I did get to play with some of the investments, but I never wrote checks. And at AngelList, I was just a matchmaker, at scale, but I was not. So I've never written checks, and I've never actually been a founder as well. So Tracy, for example, you should just, if you have any questions like really what it's like to raise money as a founder, she's the one you want to grab afterwards because she knows that much, much better than I do at this stage. So that's what I'm not. Let's spend a little bit of time talking about what people, maybe not everybody, maybe not you, but how some people think what fundraising is, right? This is kind of one conception that a lot of us had when we were in the class, excited about maybe doing a startup. We're going to do a little bit of planning, and then we're going to go get paid. We're going to make money. And then once we spend that month raising money, we're going to start building that perfect vision of what we had. That's, a bit of a caricature, but that's kind of what people think. This is like maybe what it actually looks like. Notice it's 2 years instead of 1. You maybe raise a tiny bit of money there. You raise a little bit of money here, or maybe more, but it takes 6 months instead of 1. And then you tuck a little bit more in there because people want to give you money at that stage. And all of a sudden, you're not actually planning at the beginning and doing after. You're actually learning and building the whole way through. And so it's a lot messier, and it's much more of a journey. It's not like, this one event where, come on in, where I need to get money out of somebody's pocket. It's sort of like this happens throughout, and it's a much longer part of the journey. This is another caricature of what some people think fundraising feels like. I have 3 meetings with angel investors. I'm really excited. I'm going to get paid. Or I'm flying to Silicon Valley for a week to raise money, and then I'm really excited to get to go back home and get back to work. This is just such utter bullshit. I mean, it really doesn't happen. This is what it looks like. This is, some of you may have seen it yesterday. This is the mapping of a fundraise process where every little X here is a rejection. So let's sink that in. That's 132 pitches and 14 successes. It happens. There's a timeline that's too small for everybody to see that is 5 or 6 months along the top. So it's not I get 3 meetings and I'm going to get paid. It's much more of a process. It's a matter of getting better at this process as you go. And it's a numbers game to an extent. So you never start amazing. You want to get better and better and better, and you want to close more. You want to get more effective, but you also want to put yourself in a position and a mindset and a process to be able to do this effectively. It's not a one-shot deal most of the time. A lot of people think this is what they have to solve. Figuring out which slides I can put on a PowerPoint deck that get money. We're really not going to talk about that today, because I think you guys are smarter than that. Here are all the things that actually matter and go into that process of being really effective in fundraising and getting more effective over time. First, understanding how investors think. Founder perspective, investor perspective are actually really different. You do incredibly different things every day. You have different goals. You have different experiences. So how, on the other side, understanding that context, how do they think and how do they see the world? Now, I don't mean they and as investors. I mean, this is what healthy, successful fundraisers have learned, why they exist. So we'll go existential for about 3 slides. Why are they even here? Because it's tough, and it's like kind of a big clusterfuck of rejection sometimes before you get the money. And so how do you get through that, and why are you doing what you're doing? And I'll talk about that. Finding a mindset that works while this is happening is pretty important, and that people respond to, that is authentic, is good. Figuring out which slides get dollars should actually be building a pitch story. There's only one slide that has examples of what should go on a fundraising slide in this presentation, and even that is just an example. That's not the most important thing. And then the last thing is managing a process. Successfully fundraising is not something that just happens to you. It's not something you can control, but there is a process that you can run that can dramatically improve your odds of success. And if you're just responsive and reactive, it's going to be complete failure. And even if you get money, you're really going to have no influence on who gives you money, and that's an important thing as well. Cool. So that's what we're going to talk about for the next 45, 50 minutes or whatever I have left. Cool? Thumbs up. Anybody want to violently clash with this program? No, they do have a choice, but I don't know how that's going to work out. They might not, yeah. All right, let's do it. Let's talk about how investors think. This is, I think, sometimes obvious things, but really makes sense to understand and internalize this. I also want to make this is probably a good caveat place. I'm really talking about my experience, which is heavily, heavily weighted to Silicon Valley. So investors do think differently in different geographies and different markets. So that's a big caveat. It doesn't mean you can't learn from what we're talking about. You would say, okay, I got it. How is it slightly different in the Middle East, or how is it slightly different in London, or whatever? Momentum. Momentum is everything, right? We're smart people. Which of these lines is going to get funded? Right? Green. They're moving faster. Easy to see on a graph, much harder to do when you're a founder because you don't see the other 9 out of 10 startups that have pitched them that day or in the last couple days. And what investors see is most founders think that things are going generally well and positively, and in most companies they are. But it's really only like the top 10 or 20% that are the best that are getting funded and that are moving the fastest that are getting funded. And so what investors will see is a bunch of red lines and a few green lines. And I don't really know how to solve this problem except to say that speed really matters. That denominator of progress over time, the time really, really matters. And I don't know how to make oneself faster at learning and building and selling and making progress except to surround oneself by other people who really, really move fast. And just if I thought I was going to do it in a year, I really should try to do it in 3 months. This is what accelerators do. This is one of the reasons they work well, is because they take a lot of really smart people and they kind of 2 or 3x their speed and then change their direction a little bit. Investors are not rational. It should not be shocking, right? They're not making highly analytical decisions about which companies to invest in, because that's stupid at this stage. There's such a lack of information about a company at this stage. There's so many unknowns. And frankly, some of the most outsized wins or the bigger successes are the things that seem the stupidest at the beginning. So even if you were taking a conventionally rational view as an investor, at the earliest stages, you'd probably miss out on those really big opportunities. So investors they're not stupid. They have some rational thoughts, but that decision to invest is really not rationally driven a lot of the time, I think. It's driven when the excitement outweighs the hesitation, right? When they get excited, especially if they have a partnership, if they have to convince other people to come on board. Oh, you want to raise money from me? All right, so I like what you're doing, but now I've got 3 partners who are super smart individuals, and I got to convince them to get on board. Well, I'm only going to get through that gauntlet of persuasion if I'm pretty excited. And there's always hesitations. We're not going to eliminate the red bars, but we'll figure out how to use this in a few slides. But this is what gets funded. This is what doesn't. And when stuff doesn't get funded, it's really not because there's like a very specific thing. Oh, it didn't tick these 3 boxes. It's just like, all right, I'll move on to the next pitch. That's kind of the way it works. Yeah, please.
Do you think that the same type of dynamics also kicks in with follow-up investments for some investors, or generally?
Do you mean in the same round, or do you mean in subsequent rounds?
Subsequent rounds.
Yeah.
So you already have a equal investment in a startup, and when the next round comes around, do you think investors act irrationally in the same way, or is?
No, I think they do in slightly different ways. Probably some of it's the same. They're probably slightly too attached to their previous investment, so they have some sunk cost, bias going on that's messing with them. And I would say if it's shared, then most of the excitement they would have been built in working with that startup. So you might say that in a pitch you get a lot of the data and you only get an hour or 2 of interaction. But if you're on their board for a year, you have all of that year of interactions, and that might be something that you get really excited about. Say, actually, the traction isn't there yet, but I've seen this person in action, and so I'll be, irrational that way. I think it's different, but it's still there for sure. Let's talk about de-risking. So there's always risk. There's risk for Uber at this stage, and it's worth I don't know how many tens of billions, right? So there's always risk at every stage of a company. So don't think that if your company is early that you have to worry about we have to tie up all of the loose ends and we have to convince people of everything. It's not that. And this is what happens, obviously, as you progress. You de-risk the company, you solve a lot of problems or questions or assumptions, right? The trick here is really figuring out which types of risk matter for the type of company you're working with, right? So let's look at 2 examples, right? Instagram, everybody knows about Instagram. Their risk, what do they have to answer? Can we technically scale? Yeah, they had to answer that, but even if it breaks because it's so popular, we'll find a way to solve that. Will people use it? Tens of thousands of people used it the first day, so they didn't really have to answer. Of course they have to answer that. Will people use it in large numbers? Yes, that is a critical thing for Instagram to answer relatively early on, and that actually did happen. And will we be able to keep those people? Will they be using it? Will they be obsessive about the product? Will they be engaged in that kind of thing? Do we need to make money? That is not something that matters for Instagram in the first 2 rounds, at least for investors in our pool. They pitched Greylock for a Series B. We talked about that for a little bit, just so that we can believe that they weren't total idiots. They're not total idiots. They're very, very sharp. It was a good conversation, and we're like, cool, we know how social networks work. We know they didn't get to scale before they really make money. We get that. Let's move on. So that is not a risk bucket that matters for an Instagram or something that looks like that at the earliest stages. But something like a SaaS tool, like something that helps you, like Expensify, that helps you record expenses, and you're targeting to sort of small, medium business and sort of organizations that are tens to hundreds of people. What do you need to answer? Okay, the risk. Will people use it? Yeah, that's a risk. Will they pay for it? Yeah, all of a sudden that's a big risk at the beginning. Will they be able to help it move into teams? We want to land with one person. We want to sort of expand to their whole team. That's how we think we're going to get into companies. So those are very different companies, and they're very different buckets of risk that matter at the beginning stages. And what happens as you go through pitching is that some of these you're going to answer with data, yeah, look at our traction's going like this, and we're growing and we're spreading, and that's great. Sometimes you're not going to be able to answer a specific question like, yeah, we acknowledge that growth is going to be important very, very soon. We haven't answered that with traction or with data, but we're able to tell a really convincing story about how we're going to get there. And so that's how you sort of deal with that risk in the mind. So the point of this is like, recognize which ones matter to you, recognize which risks don't matter to you, and don't worry about those ones so early on. Specific and unique. All right, so what I'm trying to get at here is that the gray dots are what investors see, and the blue dots are what you probably see if you're a founder. This is the whole universe of companies. You might know of 4 or 5 competitors that are kind of in your space or kind of do similar things. You don't see the other 90% that are actually there because your job is to running a company every day. Your job is not to meet everybody. But investors see a huge set. A typical VC probably meets 300, 400, 500 companies for pitches every year, right? So what does that mean? What is the implication of that? It mostly means that you have to be different. Different is important. We'll talk about that in a bit, but being specific about what you do, not defining what you're doing by its space. Oh, we're an Internet of Things startup, invest in us. No. What do you do? Oh, we make smart plugins for automobiles that help people reduce the cost of their driving and insurance. Okay, obviously that fits in the big, ambiguous bucket of Internet of Things, but it's specific in what you're trying to do, and that works really, really well. The follow-on to that is that a lot of people try to do this, which is, let's say you have four bars you want to optimize and spend time building a story around. My team, my traction, my market, and my product. Spend a lot of effort making sure those are all positive. You know, we're perceived as being positive in terms of our team strength and our traction and our product and our market. Usually what happens there is you get a bunch of friendly meetings. You don't get a lot of money. This might look messier, right? You might say, our team, we're kind of a weird collection of people that's come together to build this. The product looks kind of ugly. It's got some rough edges. I don't know how it's working, but holy shit, it's working. That gets funded, right? And so this team has not wasted a bunch of effort trying to tell a story about their team and like hours and hours and days improving it to be just slightly above average. They're really figuring out what makes them unique and notable. This, by the way, if you're looking for work in Silicon Valley, this works very well job hunting as well. The best example I had was a friend, his co-founders, she's a developer. The useless thing would be to say like, oh, she knows Ruby and she knows Python and you know she's really good with Django and so whatever. We were talking about it, trying to figure out his team angle, and he said, oh, well, she's written code that's powered the linear accelerator at Stanford, Slack. I was like, oh, cool. So she's written code that has driven the world's largest laser. Like, that's pretty interesting. Like, that's something that is notable that people will remember. And so figuring out what is notable is more important than credible. And this is I think the last slide I have on this one, where how investors think. I think there's some kind of, not hierarchy, but most founders and entrepreneurs live day in, day out at this level. It doesn't mean that they go up, like the good ones have visions, of course, and the visions respond to how the world is going to be and how the world is going to change. But their job is running their business. It's hiring, it's firing, it's selling, it's building product, it's writing code. That's what they're really, really good at. Investors spend the world up there. That's where they spend most of their days, thinking about how the world is going to change and thinking how these pitches respond to that when people walk in the door. So usually when you get into a pitch meeting, the entrepreneurs are really, really good at this. They'll tell you all the details about their business. So that's important. If you can't, I mean, it's a big problem, but it's something you're going to be good at because you live it every single day. Hopefully you're going to be able to tell investors about why. Like, where is this execution leading to? I promise you, only the best entrepreneurs really can tell you about the top one. And they are so exciting when they're pitching you. That changes conversations so much. If you're an entrepreneur, you can explain how the world is going to be, and you can educate an investor on how the world is going to change and how that opens up this big pocket of opportunity for you, and then how you're responding to that with your execution. That is very, very exciting for investors. Particularly, it works with the best investors. I think there's a set of investors who aren't as good, who kind of live in here, but I think some of the really good ones live up there. So spending time thinking about that is really worthwhile. Any questions about that? That was like the rapid fire, how investors think in ways that maybe the rest of us don't. Yeah, please.
So in a slide back there, there was one item on chart and the other about
Yeah.
traction. Did you pick traction specifically, or any of the four highs?
Excuse me. That's a really good question. So the question was, did I pick traction specifically to put as the bar that is high? It's the easiest one. It's the one where if you have traction, no other questions will be asked at this stage because things grow so quickly right now. But it does not have to be the only one. It would depend on stage. So often people are fundraising on team in the first round. It'll be a collection of people who built something amazing at Google and are spinning out, or who had previous successes and they're able to raise a couple $1 million on that. So that bar could be team at the earliest stages. Market, it could definitely be one of those bars could be high. Like something that either everybody or that specific person you're pitching to really understands, like, yeah, there is something here. I've been looking for this company. So that would be high. Product, yes and no, because the expression of whether product works is traction after a certain point. Occasionally, product just communicates what you're trying to do so well and beautifully that people, I think maybe it didn't work out this way, but I think Tumblr was like that. It's just like, oh, I get your worldview through your product. This is really interesting, and now it opens my mind to something that wasn't there before. And there could be other bars too. It doesn't have to be those four. It could be other investors, if you want to behave like sheep. Yeah.
Just to add some color to that, like it also depends on the the investor. Because some investors, like for us, our most recent round, we were really high on team, and then like middle high on traction, and then like lower on everything else. So I think it's also just understanding like what does the investor want, and then you but focus. Just find your focus, and then that investor that like is really attracted to product, maybe like is kind of a product nerd, and those people care a lot about it. And if your product's kind of low, like it may not even be worth pitching them.
Yeah, I think that's right. Thanks. Good question. Why you exist? So fundraising is not a fun process, except in extreme cases. It's not a fun process. It's like job hunting, except that there are even fewer jobs. So it's tough and it's shitty because most people don't start a company to fundraise. They start a company to build something. And so this is something that you also kind of have to do. You might actually enjoy it, you might grow, you might learn, but it's something you have to do. And so in preparation for this, I think it is really important to step back and figure out why you exist. First, like, not why you exist as, oh, my parents, had sex, 25 years ago. No. Like, why are you doing this thing now? What is the purpose? Why do you care? 6 weeks in, when it's like looking like it's not going to work out right before it works out, can you go back to like why you care? What is the purpose for you to do this? So if you have really strong why answers to these why questions, it is really helpful. Why are you creating this? It's like when you're hiring, you talk about, I probably suck at hiring a bunch of ways. I'm pretty good at hiring when I talk about why I care about what we're doing. I tend to recruit pretty well that way. So it's good to take some time to think about this. The next one is probably why, oh yeah, I put Tracy's photo there because I've seen this in her process, and it's been really, really interesting to watch, focusing on the why. And that powers a lot of the pitch. You'd be surprised. Not in tangible ways, but in very intangible ways. And I put Mark Ventresca. Everybody knows Mark? Yep, Mark's was my supervisor and friend since then. Awesome guy. But I think I got this one from his class. And you don't see it around Silicon Valley a lot, but it's just so powerful. Value proposition statement. Why does what you're building matter? It matters for who, the target customer, who needs this specific thing. We provide this answer that is unlike the competition, who, provides a solution that's different and not adequate at this stage. Anyways, there's a bunch of different versions of this. There's probably, they move lines around, they plus or minus a few things. But really being able to answer a value prop statement before you start helps drill through a lot of the bullshit and figure out where you are specifically better and different than everybody else. And that stuff's probably going to pop up in slides later. So it makes sense to figure out this. And a lot of your questions, at least like 50% of the basic questions from an investor in a pitch, you're going to be able to answer with these answers. This is one I got Josh, who's a partner at Greylock. I think I knew it before, but I heard him use it pretty effectively at Greylock. I really, really like this one. This is the why now. So the question is, why is now the only time that this could be created? Why are you the only team that could create this thing? And if you remember, we went up the slide from sort of like execution to vision to how the world is changing. This is getting at how the world is changing. These two questions are how you start to figure out the answer of, what the future looks like, how to describe that future. And if you can do it effectively, automatically you kind of separate yourself from a lot of founders who are also trying to get their money. Okay, so that's the why. Any questions on that? Please.
Yeah, why would that be important? I mean, I can see it for a narrow type of business, but for a lot of other businesses.
Which one? This one?
Yeah.
Why would this be important?
Yeah.
Why would it be important?
So, for example, if you're starting something new in an underserved market, you might be helped by, well, there are two other teams that can do this too, and together we'll build a new industry.
No, because I'm going to go give them money instead of you.
But from a business school perspective, that could be, there are scenarios where this might not be true. Might not be a positive thing for the investor.
Yeah, I think that's right. But I think the odds of you not getting their money because you fail to be unique and exciting as the primary vehicle for them to get to that future are much, much greater than the odds that you sort of alienate the margins of other strategies that they could use. Because you answer a question like this doesn't mean that you wouldn't say like, hey, 3 years down the road, we're going to partner with them, or we're going to try to acquire them. We are going to acquire them, not they're going to acquire us. No, this is not hard and fast. This is really saying like, let me put it this way. The reasons you're not going to get their money are not because there are other possible paths, to winning or strategies that down the road might play out. It's because they don't give a shit.
They want to hear this. That's why you got to say it.
They want to be excited. Like they're gonna invest in you to do this thing, and it's only going to work because you are the person they think can do that thing. That's the way it works, please.
And if they're investing in you, they're investing for like a 5 to 10 year horizon. They want to know that it's not just about the money, because you'll be gone in 2 years.
Yep.
So they just need to know there's something.
Yeah, that's deep. That's true.
Sorry, just following on that question, I can see how you might be able to answer, why now is the time, to build this product or attack this market. But how would one justify me and my team are the only team ever that are going to be able to build this?
Yeah.
What justifiable answer can you give an investor, and they'll be like, you guys are the only ones?
I totally get that question because, and I've it's not so that you can get a completely defensible answer.
Yeah.
By the way, in pitching, if you're trying, sorry, go ahead.
Is it just around building that excitement and showing that you showing that you need it? Oh, sorry. Is it just around building that excitement and knowing, or being able to show a sense of, belief in your own product and your team? And is it more around that as opposed to a justifiable, defensible answer to that question?
Yeah, so it is partially, I'm going to augment, and I'm going to say that, well, let me step back. You're not ever building a fundraising pitch to be completely defensible. That's a PhD thesis defense. That's a very different thing. So the more you focus on being completely defensible against all arguments from all sides, you're really wasting time and energy. When you're talking about why are the only team, this is extreme. Of course, there's objectively in the world there's better combinations of better people, but they still want to know that you're uniquely positioned. That you have something that is different about you and your team that is really conducive to making this happen. And they're not, and okay, the only team in the world. This might be the only team that they've seen. Like you're really, maybe there's going to be 10 other teams trying this, and you want to say like, we're really the most uniquely positioned out of these 10 at this time when the timing is perfect to do this. And so put your bet on us. So it's not a great answer. I know exactly where you're coming from, and mostly because my mindset has also gone from where that question comes from to a little messier place that is a little less defensible over the last few years. That's a longer conversation. That's a very good question. Cool. Any more questions? All right, let's do this. Finding a mindset. This is mostly, if there was one, I don't want to trash the MBA. I think it was a good experience. It was worthwhile for me. It was wonderful. I would do it again. Did you guys get that? But in this context, whether you're an MBA or an MBA, or just you snuck into this session, which is awesome. Right now, you're probably kind of wearing that up here. And you've either come from a career or have sort of acquired some of the sort of mindset and approaches of an MBA that are a little less conducive. Lots of people have MBAs in Silicon Valley. If you ask around quietly, a huge chunk of them do. They just put it here. They put it in their back pocket. Okay? So if there's one section of this talk that is like how to de-MBA yourself, if you want to come and sort of move and build things in Silicon Valley, this section is that. So the things that work. Be unique. We talked about that. It's funny, like once in a previous life I worked in Senegal a couple times. If I had seen somebody like, who are we going to work with? Who can we partner with? Who can we build stuff with? If I saw a Stanford graduate in southern Senegal, oh my God, that would be a really unique thing. This person would be really special, right? Look, in San Francisco, there's like you can't throw a rock without hitting a Stanford grad. So it's nothing, right? It's like what was credible. Credible is not enough, is what I'm saying. So being unique and different really works well, and it's really appreciated. And I think one of the other presentations I did a couple weeks ago, the slide was be unafraid to be unique, because I think we have a fear of being unique and being uniquely ourselves. That we have to kind of figure out. The blocks are mostly internal. So that's a big one. Unique is treasured, and sameness is not interesting, which is why we try to get you guys to take your jackets off when you come to Silicon Valley and put t-shirts on and stuff like that. Do fast is really, really critical. I think I'm gonna, I know this doesn't hold completely, but when you're looking at a job at sort of P&G or something like that, you're going to bias to analysis because you really don't want to fuck anything up. There's a lot of money at stake. There's a lot of reputation. That's not how you move up the ladder by breaking things generally. You're going to analyze. You're going to delegate a little bit more. You're going to plan a lot more, and that makes a lot of sense in those contexts. In this environment, it doesn't make sense. Like generally it's do something, learn from it. Instead of like plan, do, it's like do, learn. Do, learn. And then the fast part we talked about. Just do really, really fast. I know one of my very good friends from my year, Mike Aiello, started a company right out of the MBA, raised a little bit of money from it. Interesting company we won't get into, but he raised, it was kind of technically hard to do. He's a developer, a very, very smart guy. It took him about 1.5 years to launch his first product, and that failed, as it always does. And then he's like, oh, shit, okay. Well, I can still use the back end, and I can build a slightly different product that hits a slightly different part of the market. So he spent 6 months doing that, and that failed. And he's like, okay, well, I can again use this pretty interesting tech that I've built, and built the third product attempt in 3 months. And then the next one was in 2 months. And then at the end, he had tried 6 products, and the last one he built in a week. And this is a transition that I have gone through internally at Greylock and other places, and I see a lot of people going through, where they just don't do things fast. It takes them a long time to figure out what doesn't work. They feel shitty for a day. They pick themselves up. They say, actually, that wasn't that bad. Why did I take 18 months to do that? I can probably do it. If I can remove my ego a little bit, I can do it in 6 months, and then I can do it in 3. So fast is like not only understanding what fast means and building fast by being around people who are just like threateningly fast at how fast they move, but also removing whatever fucked up internal blocks we have on our ego that like don't let us move ourselves forward. Finding your confidence is important. It's funny, I'm Canadian, and I had friends who were from Canada who were pitching at Greylock. And this is Chad. And Chad came in, he had an e-commerce company, and he was basically apologizing the whole pitch about what was going wrong. And I was like, Chad, just sell it to James, our partner, who does that kind of thing. That's stereotypically what Canadians do. We kind of apologize. Another friend of a friend, Japanese entrepreneur, incredibly impressive entrepreneur. He was one of the co-founders of DNA, which is a multi-billion-dollar listed company in Japan. And that culture is just, I don't know all the nuances of Japanese culture. I know it's not like American confidence, right? Like there's this face, there's this subtlety, there's layers behind that. And so he didn't come across with this American-style brash, like staring daggers of confidence through the wall that we typically often see. And I think it made it harder for him to talk to investors in that environment. So there's differences, right? There's differences if you're pitching as a woman in a male-dominated environment. I don't know exactly what all those nuances are. I just know that it's perceived differently, and I think it's more difficultly as well. So there's different versions of confidence. We have confidence in different contexts. If you went back for me 15 years and said, be confident around girls, I'd be like, I don't know where to get that confidence. If you tell me like, you gotta hire this person to join your team for something you believe in, like I can hire that person. I am confident about that. Or this context, like I've talked about this a few times. I might be right, I might be wrong, but I'm pretty confident giving this presentation. So it's figuring out like, in what ways you're confident and where that comes from. And that changes for different people. That could be a different, maybe you like to win, right? There's definitely entrepreneurs who do that. Maybe you believe in a vision, that's where you're going. We're not confident about how we get there, but we are definitely confident in 10 years we will get there. And then finding like how you recharge that after people have said no 15 times. Like who's right in your orbit that's really gonna help you out. That's important. And the last thing that works really well that I found MBAs don't tend to do that much when y'all come on the treks and stuff like that is challenge us. It's the same thing. I find MBAs are a little bit deferential because they think, okay, well, he's figured it out, which is not entirely true, but he's got to a company that seems to be good, and so he's on the other side and he has some power here, and so we'll keep our options open and we'll just defer a little bit. No, like challenge me. Like I might think that you're wrong, but I'm really going to love that, or I might think that you're right and I'm going to learn something. So challenging is a good thing, and especially in a pitch, it's good as well. And it's sometimes good to reframe and think, I'm pitching them, but really also they're kind of pitching me. I might come out of this with multiple opportunities for investors, and so I want to know that they're the one that I would choose. Flip that around. So these things work really well. I also think they're healthy to do as a human being, and so that's a good thing. No, MBA-itis. We talked about this already. Don't defer. Don't try to keep all your options open. I think an MBA is really about keeping a lot of options open as long as you can to have optionality. And Silicon Valley is not like that. You sort of tend to focus and commit. The time frame you do that for is shorter, so that's why you can do it. Like I'm all in on this project for 2 years. And if it succeeds, much longer than that. And if it fails, then I'm going to be okay, and then I'll be all in on the next thing versus that. Fancy educational names don't matter. I'm sorry. Doesn't mean that you've wasted time here at all. That's not what I'm saying. But it's not like, oh, I'm an Oxford MBA, that's going to work. Within 2 weeks, I had other logos that were slightly more powerful there. Deferential, we talked. Let's talk about game changer. Oh, yeah, we talked about this before. Do not be a game changer, please. Okay, what does this mean? So I saw thousands of pitches. So that's a pretty big sample size. They were all written. And I developed a rule. And that rule I call the game changer rule, which is count the number of times somebody has used words like game changer, visionary, innovator, next generation, groundbreaking, disrupting, or seasoned professional in their pitch, and that is inversely proportional to the amount of progress that they've actually made. And so once I see it, or like trademark, or registered, or copyright, cut that out, please. Just let what you do speak for itself. Speak about it passionately, but let it speak for itself. And after I see groundbreaking 3 times on a pitch, like I really just don't care. I really don't care. It's not somebody I want to work with. And it's because the other side of that sample set is populated by really impressive entrepreneurs. Like, Greylock invested in Medium, which is Evan Williams' thing. Previously founded Twitter, before that Blogger. Really, really impressive dude. He did not talk about how amazing he is during that pitch at all. Of course, he doesn't have to. He has a reputation. But Greylock has partners who are also impressive. They still needed to be convinced. He just talked about what they were doing, why it mattered, how it responded to his vision of the future that not a lot of people saw, and that was what convinced a lot of people at Greylock, I think. So the real people, they shut up and they build and they do and they don't talk about it. Okay, so that is the mindset stuff. That's kind of like just hitting people over the head. Any questions? No. Let's talk about building a pitch story. Here's that one slide where I was like, hey, here's what can go in your slides, right? You can have a story slide, you can have a problem slide, you can have traction slides, you can have distribution slides, you can have defensibility slides, you can have lock-in slides, whatever. You can get lists of these online. We can talk about it after. I think this group is smart enough that we don't want to spend time talking about the ingredients that go into a pitch deck. Because frankly, people spend too much time on the ingredients and way too little time on how they go together. And that ends up looking like this, right? Fun, but I'm not going to eat that cake. This is what happens when you focus on the slides and not the story. So if we go back to those 12 slides that I had there, what you're really looking for is the narrative arcs that tie these slides together. So any hour-long pitch, let's say we're talking about an hour-long pitch, any hour-long pitch is not going to be one completely smooth story between all the 12 slides. What you're going to have is a few narrative arcs in them. So, and this is a very stereotypical structure for a deck, but like you can move this around. There's a lot, like you might want to have traction might be amazing. If your traction is amazing, it should be in the first 1 to 3 slides, right? If the team has sold a company for $100 million plus, it should be in the first slide probably or something like that, right? So this is only an example, please. But it's kind of how it works, right? So there's story, problem, market. This is the story. This might be a founder story. Here's how I uncovered that need. Here's the problem I saw when I was working at P&G. I couldn't do this big thing that, thousands of other people like me with lots of money to spend also couldn't do. That might be, there's this massive hidden opportunity story arc, right? Solution, product, traction. Here's the solution to that problem. Here's the product we've built to address that solution. And here's how it's worked. So that's like a response narrative arc, right? There's this massive hidden opportunity, and we've got it. That's probably not the right thing to call this, but it's like, here's our response, and you can see it's working. What kind of business do we build on top of this initial product that seems to be working? How do we get it to go even farther into a much larger group of people? And then on an economic basis, do we make money as that happens? This is like, it's an awesome business, right? There's this massive opportunity. Our response has been amazing, and it's working. The market says it's working. And as it's working, like, there's a ton of money there, okay? Roadmap, team, fundraise. Do you want to join us? So there's 4 stories in this pitch, in this 12-slide pitch deck, which feels to me, after seeing a bunch of them, like that's kind of normal. There might be 3, there might be 5, in 12, 14 slides. But what you're really trying to do is like the fundamental unit that matters is not the individual slides. It's like the small group of them that fit together. And then this group usually fits pretty nicely with the next group if you move them around. And we're not going to talk about it a lot because we don't have a lot of time, but storyboarding, like the movie industry does, works really well for this. You just get your team, and you write a bunch of boxes, and you figure out what the message of those boxes and how they go together, and you move them around, and you say, no, it's not working this way, it's not working that way. It's a process of iteration of just moving these parts around and figuring out how they work together to form a story. Okay? And you might have like a section on your whiteboard over here with like all those other slides that might go in it but don't really fit yet. Okay? So I think most people overlook this, that it's really about finding these narrative arcs instead of like the individual slides, instead of the ingredients, right? How does the egg go with the flour, go with the, that kind of thing. So the question is, how do you find them, right? Well, I don't have a good answer to that yet. This is one of the things I'm interested in figuring out now as I work with founders, but they can come out of the why exercises, like why is now a good time to be doing this, right? Why are you the only team that can do it? The value proposition, holy smokes, there's probably like 3 or 4 narrative arcs in there. And you might be building these sort of arcs on the side of a whiteboard, and one slide might be used in a bunch of them in different ways, and that's fine. I don't know why I put your awesome shit there. That's funny. There's probably a reason, but I probably also did it late at night, jet lagged. Anyways, doesn't matter. It's not, it's not the best. If it is, it's not placeholder text, but if it is, that's awesome placeholder text. That's awesome shit. And then there's a bunch of standard narrative arcs that people seem to use a lot. The problem, like what is this problem that we're trying to solve and how big is it? There's an answer, which obviously goes after the problem. How we become big seems to be one that is important. That's probably like there's 2 to 4 slides of different things depending on what your startup is that matter there. How we defend. This might be a competitive slide. It might be a 2x2 matrix. Those work well. Yay, we spent 80 grand and we have 2x2 matrices. Got it. Sorry. No, those actually work. They do work really well. But it might be something like, here's how we gain a lock on the industry and lock out other people, or lock in our customers on one side or the other. That matters. Here's how network effects take hold. Here's how the future will look. Here's how we make money. These are all things that you would describe in a few slides. I'm conscious that I'm bashing the MBA a lot right now. There's a lot of love here. You don't have to worry about that. But all right. This is a basic one, right? Please, when you're getting near the end of your deck, just cut shit out of it, right? Perfection is when there's nothing left to take away. Let's talk about why this actually matters. Remove ineffective images, background, clip art, arrows that don't point everywhere. Just cut that stuff out uncomfortably. Max a few words. Once upon a time, I was part of a sort of not quite pro community of photographers called JPG, like really good amateur photographers, or pretty good in my case. And I realized at some point, I was like, if I put my 3 best photos that I've ever taken up on my profile on JPG, people would be like, this guy is an amazing photographer. Have you seen this? This guy's an amazing photographer. If I put my top 10 pictures I've ever taken in my life, this guy would be like, this guy is a really good photographer. If I put my top 50, they'd be like, this guy is an okay photographer with 3 amazing photos, right? That's the way it works. And the point of that is you're always going to put your strongest evidence as bullet point number 1 and your second strongest as bullet point number 2 and so on. And what you think when you're putting a 6th bullet point on a slide is that this is additional, this adds to my message and it strengthens my case. But what we're probably seeing on the other side is, oh, now I know how weak you get quickly, right? And not only does that happen, but the 6th bullet point distracts our attention from the first one, which is probably 10 times more impressive. So that's why we leave the 4th and the 5th and the 6th bullet points off of a slide, and that's why we leave, the 21st, 22nd, 23rd slides out, because we want to keep it focused on the best stuff, and we want to give the impression that that's what we're about. Formatting, simple stuff. I mean, it's really just like find a friend who's a designer and pay them in beer to really clean this up once, and then you should be good. Then there's a process of improving it, right? So I did that study with Daniel. He went and pitched all those investors and raised $1 million. I actually didn't include a couple of bullet points when he hadn't really figured out what he was pitching yet. He thought he was pitching for a $10 million check in a Series A, and the market told him pretty quickly he was pitching for $1 million in a seed round. And he's like, oh, okay. Well, I didn't know that. The point is that the pitch is never perfect. It's really never going to be perfect. It's a process of iteration. So what you want to do, the best thing to do is to find 5, 10 people who are pretty good, who know what they're talking about. They might be investor friends who really will not bullshit you. They might be other founders or entrepreneurs who are a couple steps ahead and have raised money. And you give your pitch to them, and they cut it apart, and you make it better, and you go to the next one. And one of the exercises you can do at that time is what I call the excitement and hesitation game. We could do it here. I could give you my pitch. I could say, every time in my story there's something that is exciting to you, just make a note. Every time there's something that causes hesitation, make a note. Oh, you don't have any engineers? Oh, trying to build tech? Okay, that's And then so you do that, and you get them to build a list. And usually it's like 3 or 4 things on each side that you get excited about in a pitch, 3 or 4 things that you're hesitant about. And then I compare your list with your list with your list with your list, and I say, oh, the top 4 things that are coming out that people are getting really excited about are these 4 things. So those are going to be crystal clear in my pitch. They're going to make it up near the front of my pitch. We're going to anchor stories around them, that kind of thing. And here's the things that people are really tripping up on. We're going to make sure that we address them so they're not in the back of people's minds as we go through the pitch, or we remove them from the pitch if we can. But here's a way that you just sort of distill what creates the sort of like excitement bar, to be really high and allows it to be really high and allows the hesitation bar to be really low. So this might be like a process of pitch improvement. You might figure out like the why stuff. Why do I do this? What is our value prop? Why now? You might start storyboarding and finding narrative arcs with the founding team, or smart people. You might bring your sort of, you might start formatting and cut the fat once you figure out, oh, there's some good stories, let's cut all the crap out. And then you might play the hesitation and excitement game with a bunch of people who know, and then you might go on and play, do real pitches with investors after that. So that would be like a process of improving a pitch that would work, and you'd probably do that over a few weeks, right? All right, let's talk about the process after a pitch. This is the last one, and then we're going to get a little bit of time for questions. Managing a process. First, you should just go to venturehacks.com and just read everything they wrote. We don't have to spend time on that. After Venture Hacks, they started AngelList, so they know what they're doing. They wrote essentially about game theory in fundraising from an entrepreneur's point of view and how to create a market during a fundraising process around your equity. So they were kind of among the first to do that. Really, really good material in there. It's worth spending a day just powering through that. Venturehacks.com. And just go to the archives. The principles, we talked about the principles in iteration, failure, learning. It's a numbers game. If it's a seed round, you're going to have to pitch 50 to 100 people. So you know that, so you don't feel bad when you have to. You also know that you have to do that efficiently. So how do I get 50 to 100 names? How do I find them? How do I access them? How do I start to batch process that? But you just level set that it's not going to be like 4 meetings and I'm done and it works out. Okay? It's momentum driven. I don't know how to solve this problem. One investor comes on board, a second one, then quickly a third one, then a fourth, and then the round's closed. And before that, it had been like a month of silence. It's human dynamics and it's group dynamics and it's a network-driven thing. I don't know how you solve that problem. But you can quarterback the process. This is something that new founders tend to be intimidated by. Impressive people can connect you with other impressive people or whatever. Tell them how to help you very clearly at the right time. I was like, okay, you mentioned you could make an introduction to these 3 investors. Can you do that now? Is that possible? Here's some text that you can use to forward to them. 3-line email, right? So that's the kind of thing, and you do that to that person, and that person, and quarterback it. And then you create a market for your startup. You pitch them all at the same time if possible, or compress that into as short a time frame as possible, and Venture Hacks tells you how to do that. A process might look like this. These are in weeks. You might collect your team, and by team I mean like, not your startup team, but who are the 20 people in your orbit that can help you? that know you, that like what you're doing, and they're good. Friends that are really good at this, other founders, stuff like that. Who's on your team? Work on the pitch improvement stuff, generate an investor list. Like, if you want my help, please come to me with like 50 names. If you can't come up with 50 names, then come on. It's 2015. There's LinkedIn, there's AngelList, there's Crunchbase, there's all of these resources. So you generate an investor list, and you start to rank them. Here's my first choice, here's my second choice, and here's my third choice. And you do that partly because it's fun to judge people, but mostly because eventually you're going to pitch your second choice investors first, because your pitch is going to suck, and you want it to suck with the people who are slightly less important. And if you get some money from them, that's great, because when you go to your first choice investors, they're much more likely to say yes, because you already have money in the bank. So that's why you do it. You might have a demo day if you're a part of an accelerator. So that would kick it off. You'd pitch your second choice investors first for a couple weeks. Start pitching your first choice investors. You might use AngelList or some other platform at that point to coordinate sort of like a push outwards, and then quarterback that, and then you might do follow-ups. Okay. The point is not that this is exactly the way it's going to work. The point is that if you make it intentional as a process, it goes much better versus being reactive. And if you can manage that process, you're not going to be able to control it. There's no way. But it will go much, much better. So it is a process. It does not just show up at Silicon Valley and 4 weeks later, money in the bank.
Brendan, we have about 5 minutes.
Cool. I think we're almost there. Okay. If you're coming to Silicon Valley, it might involve trip, and then that. The head fake. What is the head fake? Good timing. The head fake is really that this is not just about getting money out of people. This is about figuring out how to build stuff, figuring out how to get people on your team, figuring out how to get people excited, figuring out how to grow as a person in that process, and figuring out how to increase your odds over a long time frame instead of just pitching. That's all I have. I'm sorry we don't have time for that many questions. Thank you.
Oh, but a few.
We have, time for a couple.
Thank you so much.
Hi, Brendan. First of all, thanks a lot
There you are.
for coming out and the presentation. I was curious, you said your first job after the MBA was at AngelList, is that right? And you're the second employee. Could you just talk about what you saw with them that made you feel like, it had momentum to be something you wanted to join as employee number 2? Yeah. And also if there's anything else out there, like very young firms right now in the Valley that you would, if you were doing this again, that you'd be interested in.
Yeah. Okay, so this is probably the only question we're going to answer because I think it's important and I want to talk about it. And then other questions I'll stick around and we can talk after, okay? I didn't have a lot of choices. What I knew when I was finishing up the program, I didn't know much, but what I knew is that I wanted to be in the Bay Area and I wanted to be surrounded with really good people building things. That's it. I had 2 connections with people in Silicon Valley. And not even like either connections through people, right? And AngelList was one of them, and Nivy was one of them. It was nothing at that stage. It was a WordPress blog, 30 investor names, a Woohoo form for startups to apply, and Gmail. That was our stack, right? But what was interesting about them is that like even if there's 30 investors, if they're kind of at the center of this world, it's a good place for me to spend a little bit of time. It'll be a good landing pad. Here's how I got that job. Nancy sent an email to one of the co-founders on Wednesday. 2 hours later, we had a Skype call. An hour after that, we said, yeah, let's try this remotely for 3 days from Oxford. On Friday, we said, is it working? On Saturday, yes was the answer. On Saturday, I booked a plane ticket. On Sunday, I flew. On Monday, I was in the office. The first day, we had an office. The lesson that I think is really, really important is I was very, very assertive in finding a home. They didn't know what the hell they were going to do with me. I'm going to show up. I want to work with these people. We'll figure out what I do after, and then we did. And too many times in other industries, it's like, well, I'll travel, I'll live in, I don't know, Sao Paulo when I find something that allows me to get there. And in Silicon Valley, it's just not that way. It's like you go, you figure it out, and you land, and then you find your path. And most people, I might be diverging a little bit, but I think it's important. Most people, I think, if you're going from here to there, you're really optimizing for 2 years out. You're saying like, I don't know how I'm going to land here, but it's so much of the opportunity is hidden in Silicon Valley below the surface, and it's so easy to find paths to something else, and people move around so fast that almost nobody I know landed there in the perfect spot. almost everybody I know was in a really good spot 2 years down the road because they jumped in assertively to the first thing and then learned. So it was a crapshoot with the company. It was all luck. Not all luck. It was mostly luck. We could have a longer conversation about small companies that I think are interesting afterwards, but I don't think that's really the point. It's like, just get yourself there, commit, and then use that to look around and figure out where you really fit. Yeah, follow up if you want, that's totally fine.
Yeah, I think thanks, yeah, that's good.
Yeah, and Greylock was the same way. I hustled them off of Quora. I messaged John off of Quora saying, hey, thanks for the voting up my content that I wrote. I have an exploding offer with another venture firm. Do you want to talk? And he's like, yeah, come into the office. And I had a contract 8 days later. Like both of these situations, I was just really, really assertive. Uncomfortably assertive for me. And it worked.
For a Canadian.
For a Canadian, that's right. Thank you very much, yeah. Do we have time for one more? We have one more?
Yeah.
Awesome.
I guess following on that, do you have opinions on working in a small team, 5, 10 people versus going to a place?
Oh, those are still pretty, yeah, this is a good question. Small, 5 or 10 people versus 50 to 100.
Yeah, still small, but
Still small.
different stages.
A lot of it depends on your tolerance for risk, and so 50 to 100 is probably like after they've raised a Series A or B or C or something like that, and so yeah, you're like, okay, they're going to be alive for 18 months at least, right? But a 5-person team might be alive for 6, and so obviously there's some bigger payoff, and it's sometimes more exciting if you're earlier, but if your risk tolerance is not that high, you want to go a little bit later. The other thing that it tends to impact that is what your functional area is. So right now, for most of the stereotypically tech stuff, if you can code, that's great. You can be a first 5. A designer will probably come in around 6 to 10. A generalist business person might come in around like 15, 20, 30, depending on the company. Marketing people, if that's your background, you can come in around 10, 15, 20, very much depending on the industry. And so for me, one of the reasons I wasn't a long-term fit at AngelList is because the sort of like want to have a founder mentality, want to build product was already the 2 founders. There wasn't space for a third person there. One of the companies I got very close with before we had to cut off the process was Airbnb, and they were just big enough that they could start hiring product managers to build other chunks of the product, the 50th person in. So my fit in that function made a lot of sense as like the 50th or 60th person in a company like Airbnb. So it depends. I think the quality of the team is much, much more important, but that's not a way to search, that's the way to filter. So that's not helpful to find the companies. It's just to say, I won't work for anybody if these are not amazing people. Yeah. Yeah. It's a good tactical question though. Yeah. Cool. I'll stick around and we can ask questions
I think
after.
we'll wrap this up now. So give a round of applause, Brandon. Thank you so much.
Thank you.